So, you're thinking about angel investing, right? Well, the conventional wisdom always says to wait. Wait for traction. But what if the smartest move is actually the exact opposite? Today, we're going to break down a really powerful idea: how writing that very first and often smallest check can give you a massive, massive advantage. I mean, this is the question, isn't it? This is what keeps so many aspiring investors just sitting on the sidelines. It feels like this huge leap of faith, right? You're jumping in when it's all just an idea, maybe a few slides in a deck. But is that really the riskiest moment? Let's dig into that. And this quote right here, it just nails the core of this whole strategy. See, it's not about waiting around for proof to show up. It's about getting in there early enough to help build that proof. And that one simple idea, it flips the whole mindset on its head. You go from being a passive spectator to a really active partner.
So that shift in mindset leads us right into this classic problem, the angel investor's dilemma. I'm sure you know the feeling. It's that constant tension between the fear of moving too soon and, the fear of missing out completely.
You've heard this a million times. I guarantee it. It's the safe advice. Wait until the company's got customers, some revenue, some momentum. Basically, wait until someone else has taken on all that initial risk. But here's the thing. What if that safe advice is actually causing you to miss out on the very best opportunities? All right, so to really challenge that old advice, we have to tackle this idea head on, what I like to call the myth of early risk. It is definitely time for a completely new way of looking at this whole thing. And here it is. This is the key reframe you need to make. The myth says that being early is where all the risk is. But the truth, the real risk isn't about being early. It's about investing when you're blind. The danger isn't when you write the check, it's how much you know when you do it. And being early absolutely does not have to mean being blind. So you're probably asking, okay, how do I not be blind? Well, that is where this concept comes into play, the validation safety net. Think of this as the playbook for modern founders, a way they can systematically eliminate risk before they even think about asking for a single dollar. Now, this safety net, it's built by a very specific type of company. We'll call it a freedom startup. And this is not just any old startup, okay? This is a special breed that completely changes the risk equation. They do all the hard work of proving their idea first, so when your money comes in, it's an accelerator, not a lottery ticket. So what's their secret sauce? Well, it's not magic. It's a really clear, disciplined process. First, they don't start with just a cool idea. They start with a real, validated pain point that people actually have. Second, they know exactly who their first customers are going to be. And third, and this is huge, they often sell pilot programs before the product is even fully built. They're getting actual commitments, not just nice compliments. And this is so important to get. When you write that first check into one of these freedom startups, you are not paying for them to just wander around and figure things out. No, you are funding a well-defined plan that already has proof from the market. You're basically pouring fuel on a fire that's already burning.
Okay, so this brings us to something that might feel a little backwards at first. You'd think, if these startups are already de-risked, maybe you should write a bigger check, right? But actually, the best strategy is the exact opposite. Let's get into why smaller checks really win.
See, by being the first one in with a smaller check, you get a whole bunch of strategic advantages. First off, you get in at a rock-bottom valuation, which maximizes your potential upside. You also gain real influence, a seat at the table to help shape the company. You build a deep, genuine relationship with the founders. And crucially, it lets you spread your money across more companies, giving you way more shots on goal.
I mean, this quote just says it all, doesn't it? We've got to stop thinking about that first check in terms of risk and start seeing it for what it is: strategy. It is your absolute point of maximum leverage as an angel investor.
Okay, so this all sounds great in theory, but let's get real. What does this actually mean for your bank account? Let's talk about the actual, tangible financial payoff of doing things this way. This is the bottom line question, isn't it? It's what everyone wants to know. If you follow this playbook, what kind of returns can you actually expect? Well, first, let's talk about how much you're actually putting in. The beauty here is you don't have to bet the farm. The sweet spot, the optimal first check for this strategy, is in a surprisingly accessible range. We're talking just $25,000 to $50,000. This isn't about being a millionaire, it's about being smart, and it makes real angel investing possible for so many more people. And here's the payoff. With that small strategic investment, you're looking at a realistic return of 5 to 10 times your money.
Now let's be super clear here. This is not about chasing some mythical 1000x unicorn. This is about achieving a tangible, repeatable return by investing in a very specific type of company that's capital efficient and already de-risked.
You might be thinking, wait, 5 to 10x, how is that so achievable? Well, it's because these freedom startups, they're just built differently. They're lean, they're focused, and they're not swinging for a billion-dollar home run. They often aim for a quicker, more modest exit, maybe in that $15 to $20 million range. And what that does is it lets you get your money and your returns back much, much faster so you can turn around and reinvest in the next great opportunity.
Okay, so let's tie this all together into something you can actually use. What is the actionable playbook you can walk away with right now? Here it is. This is your new filter for investing. Stop looking for just a brilliant idea. Instead, you need to look for founders who show real discipline, who have tangible proof of validation from the market, and who are absolutely obsessed with speed. That is where the real de-risked opportunity lies.
And that brings us full circle, right back to where we started. The real advantage isn't in finding something that's already a runaway success. It's about finding a de-risked plan and giving it that crucial first push. So the question I want to leave you with isn't, when should I invest? It's, how can I be the one who helps create the next great company?